morning, Trinidad and Tobago, and welcome to the Bourse Report. Well, today we're switching gears just a little bit away from financial results to reinforce that important concept for all of us who dabble in investing and are seeking to secure a financial future. And that is the fact that everyone can invest, and investing is, in fact, for everyone. However, not everyone will invest the same. And today we're taking a look at some of the different types of portfolios that might be involved broadly for different types of investors with different types of risk appetites, return objectives, liquidity needs, and investment time horizons. And that, of course, will be broken down further. So let's get straight into it. And of course, as we mentioned, investing is for everyone. But again, not everyone will invest the same. And really, when we look at everyone's unique circumstances, of course, there will be some unique attributes to each individual's portfolio. However, these different portfolios and different types of investment philosophies can be broadly broken down into three types of investor risk profiles. Of course, we're talking about the conservative investor risk profile, the moderate investor risk profile, as well as the aggressive investor risk profile. And now we take a look at these three different types of categories of investment profiles, and they are, of course, segmented by four major different types of categorizations or characteristics broken down, as mentioned, in terms of risk tolerance, return requirement, time horizon, and your liquidity needs. How quickly do you need to get your cash back in the event of an emergency? So let's look firstly at the conservative investor. The risk tolerance of the conservative investor, as the name would imply, is usually on the lower end of risk tolerance. Return requirements are, of course, broadly categorized as income generation with a bias towards capital preservation, wanting to keep up at least with inflation to preserve your real wealth and not lose any money. The time horizon for the conservative investors generally at the shorter end of things, while liquidity needs typically tend to be high, which would roughly be translated into, if I need to get my money back fairly quickly, I can do so with little or no loss to my capital that I would have invested initially. In the middle of things, that is the moderate investor who has a medium type of risk tolerance with income generation from the investment portfolio, as well as capital appreciation being at the front burner in terms of return objectives. The time horizon for a moderate investor can vary, but it's generally longer than that of a conservative investor, meaning that they are willing to tie up their capital and tie up their investment funds or proceeds for a longer period of time to be able to ride out different types of economic cycles and market volatility in the hopes of generating potentially greater returns on their investment portfolio. And liquidity needs for this type of investor tends to be a bit lower. They are willing and able to tie up those investment funds or deploy those investment funds for a longer period of time without the need to quickly withdraw those funds. At the total other end of the spectrum from the conservative investor is the aggressive investor risk profile, whose risk tolerance tends to be much higher. Income generation is important, yes. However, the aggressive investor seeks to accumulate and grow their wealth as quickly as possible over the long term, or as greatly as possible over the long term, and capital appreciation, therefore, is as a higher priority for this type of investor profile. Their time horizon is generally on the longer end of things, again, willing and able to ride out investment and economic cycles, and liquidity needs tends to be low. They typically put this cash away or put these funds away for the long term, in again seeking that significant capital appreciation through deploying these funds into various riskier type of investments. Now, how does the investor portfolio allocation look for these different types of investor profiles? Well, for example, on the conservative end of things, there would be lower risk investment solutions that would comprise a higher portion of this type of portfolio. And of course, we're talking about, for example, income mutual funds, which might be about 10% of the overall portfolio. Repos and fixed deposits might comprise about 35%, and bonds might be another 35%. Cumulatively, of course, just about 70 to 80% of the conservative investors' risk or portfolio allocation rather would be allocated to lower risk type investments, whereas a smaller portion, just about 20%, would be allocated to higher risk types of investments, such as equities. The moderate investor portfolio would lie somewhere in the middle, with just about a cumulative 60% allocated to lower risk investments, whereas 40% would be allocated to higher risk, such as equities. And on the aggressive end of things, again, seeking those more significant capital appreciation opportunities, about 70% or so on average, would be allocated a much higher allocation to high risk or high return, potential return investments, whereas a much lower allocation to low risk and low return investments would be allocated in aggressive investors' portfolio. Ultimately, again, these are just broad guidelines, and every investor's portfolio allocation would be really tailored to their own particular needs and wants and desires. Now, in terms of the investment opportunities around or available to investors, we have broadly categorized some and aligned them by their investment return and investment risk to give everyone or the audience an idea of what they should be looking at based on what their risk tolerances are. So at the lower end or more conservative investor risk option alternatives investment menu, we have repurchase agreements or repos, fixed deposits, and income funds, which offer, in terms of return and risk, a lower combination of investment risk, but a lower combination of investment return as well. Somewhere in the middle of things, there are investment grade bonds, which offer a balance of investment returns and risk, as well as balanced funds such as growth and income funds or retirement funds, as well as value stocks, those stocks which generally pay a fairly predictable dividend with solid business models, as well as their ability to slowly grow their capital or the value of their stock prices over time. And at the higher risk, high return end of the spectrum, we have high yield or non-investment grade bonds, index equity traded or exchange traded funds rather, as well as growth stocks who do not really pay a dividend that much, but they have, or they promise investors the opportunity of significant returns on their invested proceeds through share price appreciation. So this is just generally a menu, and one of the key takeaways here for investors is that there is more risk that is associated for the higher return that you are willing or able to pursue in terms of your investment opportunities. Now, overall, when we take a look at value stocks and the stock market, the Trinidad and Tobago Stock Exchange, for example, we can see that by sector, there's a very wide range in terms of dividends that are on offer for investors across different sectors. The banking sector, for example, on average offers investors a dividend yield of about 4.8%. Manufacturing 1 and 2 offers investors a dividend yield of about 5%. So looking at the face of it, one would think, all right, well, let me get involved in the manufacturing sector, 1 and 2, for example, and some of those stocks. However, of course, dividend is just one aspect of the return of an investment, particularly for stocks. And of course, capital appreciation or capital preservation attributes are another aspect that investors should carefully consider. So of course, it always makes sense to consult with an experienced advisor when thinking of adding equity to your portfolio. Now, overall, we've spoken about the 3 different types of investor profiles and investor portfolios. What would that generate for an investor in the current environment? Well, when we take a look at the average conservative portfolio, for example, that portfolio structured in today's current environmental conditions would generate an average rate of return of about 3.8%. The average moderate portfolio would generate a rate of return of about 5.25% in expected returns. The average aggressive portfolio, again, with the higher risk, higher return alignment, would generate just about 7%. Again, these are based on historical and current returns as well as expectations for the future. Now, it's important to note that all of these various portfolios, regardless of the risk profile, would have beaten the average 5-year TNT inflation rate of just about 2.7%. So that again highlights the importance of investing over time. So what are the key takeaways today? Investing is for everyone. Not everyone invests the same. There is greater risk that comes with the pursuit of greater investment returns. And of course, it's always important to grow your wealth, at least at a faster rate of relative to inflation, and preserve the real value or grow the real value of your wealth. So again, it is always important to invest. So that's it for this week's edition. For more information, you can give us a call at 226-8773 or to Bourse. Email us at info@boursefinancial.com. And of course, you can check out our website, where all of our research is absolutely free at bourseinvestment.com. So until next time, stay safe, happy investing, and we'll see you again on the Bourse Report.